Most people think that 20% down is always the smart move when buying a house. But what if I told you that putting less money down could actually make you richer? So in this video, I'm going to show you the real math with actual numbers so you can stop second guessing yourself and make the decision that's right for your financial future on how much money you want to put down. So we're going to use my loan comparison tool to compare 20% down versus the minimum 3% down. Now, of course, you might be somewhere in the middle of these two. We're going to look at the extremes, and then you get to decide what's going to be the most comfortable for you with your down payment, because choosing a down payment can be really overwhelming, and a lot of people just kind of pick a number because it feels right. They just kind of round it off to 10%, 15%, but they're not actually tailoring it to their goals. So what we're going to do is we're going to look at a $500,000 purchase price. We're going to ignore property taxes and insurance right now because they don't matter to us comparing down payments. Now, for our two loan options, we have 20% down and 3% down. So they're both going to be conventional loans, 20%, 3% down. So 20% down is $100,000. 3% down is $15,000, right? So it's going to be a lot easier for you to purchase a home with 3% down, 5% down. It's so much easier to save for that than the $85,000 gap between the two of them. Where they're both going to be 30-year loans. The 20% down, we're going to look at a market rate of 6%. The 3% is going to have a slightly higher interest rate of 6.3%. And then also, when you're putting less than 20% down on a home, you have mortgage insurance. So we're going to factor that in here as well, around $240 per month. Okay, so let's then take a look at these loans over time, because a lot of people just compare the upfront. They just look at their first payment, they look at the upfront costs, but we want to look at that loan over time. That's the most strategic way to analyze, is this the best option for you? So on average, people in the US tend to be in their home for 10 years. So we're going to look at 10 years here. And so when we look at the breakdown between these two, we can see that what we're seeing is monthly mortgage insurance. So 3% down is going to be about $27,000 of mortgage insurance. And it's also going to have higher interest, $284,000 compared to $222,000. So 3% down over 10 years is going to cost just shy of $90,000 more than 20% down. So the problem here is people look at this and they're like, well, between the mortgage insurance, that's, $250 per month extra, and then the higher interest rate, well, of course, 20% down is going to be better. And so what they do is they're like, well, I'm going to save the $85,000, which is going to take a long time for most people to then save 20% down. So they're missing out on appreciation gains, which I'll show you here in a second. But what a lot of people miss in here is they're missing opportunity cost. So when we're comparing what type of loan is better, what strategy is better for you, we need to also consider opportunity cost, right? So for instance, if you were saving or comparing 20% down versus 3% down, well, that $85,000 difference in down payment, if you're doing 3% down, we need to understand, what are you doing with that $85,000? Because what if you invested that money? So when we're comparing these two, we need to look at the opportunity cost, right? Because if we choose 3% down, it's going to cost us $89,000 more than 20% down over 10 years. So is there a way that we can offset this? Well, one of the things that we can do is we can look at an investment calculator. So in the very beginning, if we did 3% down, we have that $85,000 theoretically that we could put into investments. Okay, so we'll put that as a starting amount into an investment. What would happen over time is we would actually end up with $170,000. So we would gain about roughly $85,000 in interest over that 10-year period. So then when we compare these two, 3% down is actually only $4,000 more expensive over 10 years. So I just want to illustrate this because a lot of people feel so much pressure that they need to do 20% down, when in reality, you can still do the minimum down payment, and then you can take that money and put it into an investment fund that is completely hands-off, that you don't have to worry about. You're not like actively trading. You're just using a mutual fund that tracks, maybe the S&P 500, for instance. And so that becomes really easy to make this comparison here, because now what you're looking at is, okay, well, instead of tying up all my money in a home, I have this cash a little bit more liquid. So let's dive a little bit deeper into the pros and cons between these two. So for 20% down, some of the biggest pros here are that you don't have any private mortgage insurance, okay? That's not going to be a monthly consideration. Also, 20% down is going to have lower monthly payments. The higher that down payment is, the lower your monthly payment is going to be. And so when you're looking at what down payment number to choose, that's the main thing that you're using your down payment to kind of leverage what you want your monthly payment to be. Also, you're going to get better interest rates with 20% down. and you're going to have more equity in your home, meaning it's going to be easier to sell if you need to in the future. Now, some cons here, of course, large upfront cash is required, and also that money is tied up in your home. If you're using a lower down payment and then investing the difference, you have that money that's a lot more liquid. So you can sell, those investments if you need that cash, versus if it's in your home, you can't just pull it out easily. You would need some sort of instrument to pull it out, like a home equity line of credit or a cash out to get that money back, which can be really difficult if you need it in an emergency. It also can potentially deplete your savings or emergency fund. I see a lot of people, they drain their bank account because they think they need 20% down, because they only look at the numbers without considering the opportunity cost of their money as well. And so that's what you're missing out on with a 20% down payment. Okay, it doesn't mean it's a wrong decision. It just means we need to look at the full picture of comparing down payments between each other. Now, with the minimum down payment, it's a lot easier for people to get into a home, because saving 20% down can take years, right? Think if you're in the difference right now where you're like, I can do 3% down, but 20% down is not something you can do right now. How long is it going to actually take you to save 20% down? And by that time, our home is going to appreciate a lot more and make it more difficult for you to purchase that home. Also, you can save cash for emergencies if you need to, invest that remaining money elsewhere. Some of the cons here, you are going to have a higher monthly payment and private mortgage insurance with that. You also are going to have less equity in the home. So if you need to sell the home in a pinch, it could make it more difficult, or you might need to bring money to the closing table if your home does depreciate in value. And then also, you're going to potentially have a higher interest rate. Now, remember, you can always split the difference. You can do 10%, 15%, whatever down payment you want. We're just showing the extremes here to kind of illustrate what these big differences look like. Now, a lot of people don't actually consider the cost of saving 20% down. So if you're saying, I want to save 20% down, what actually is the downside to that? So in our example, right, that $85,000 difference between 20% down and 3% down on that $500,000 home, how long will it take you to save that amount of money? So even if you were saving $2,000 per month every single month, it would take you 42 and a half months. So over 3.5 years to save that amount of money. That's $2,000 every single month for 3.5 years. Meanwhile, that $500,000 home, that home is going to increase in value over that same period of time. So if we look at a 4% appreciation rate, which is actually lower than the previous 10 years of appreciation that we've seen historically. So 4% appreciation over 3.5 years, that means that $500,000 home is actually going to appreciate to roughly $573,000. Okay. So that amount of money you saved, that $85,000, so $100,000 total, because we would have started with $15,000, saved $85,000 to $100,000, that would only be a 17% down payment on the new price of that home. So you can see the appreciation often outpaces the savings that most people are able to have. Now, if you want personalized numbers for your situation, you can get a custom quote with our team at winthehouseyoulove.com. We're licensed in all states except for New York, and all of our loan officers have the heart of a teacher. So if you want to understand what a down payment would look like compared to the monthly cost for different scenarios, reach out to our team and we'd be happy to help. And so what we can help you do is get pre-approved for a loan so you can see what you can afford, what's in your budget, what the upfront costs are, and what the monthly payment is. And then you can go shopping for homes knowing exactly what's in your budget. That way, when you find a home that you love, you can go ahead and write an offer to win that. So in here, which should you choose? So I would suggest going with 20% down if you have plenty of cash reserves left over after you pay the 20% down, and lower monthly payments are the most important to you. Now, the minimum down, or somewhere in between, is going to be if 20% down or that higher down payment would drain your emergency fund. You absolutely do not want to empty your bank account to buy a home. Also, you can invest the difference at higher returns. So a lot of people, I think, get really stressed out when they hear the word invest because you might not be familiar with investing. Investing is not some big complex thing that you need to do. It doesn't take a lot of time and energy. One of the best tried and true ways to invest is to use an index fund. And so index funds are low cost. You don't need some sort of advisor to do the work for you. And basically, you're purchasing shares of this index fund. It tracks the top 500 companies in the US. So it tracks the S&P 500. And so that's what I do. I use VOO, V-O-O. And so you can simply open a Vanguard account and then put your money into that VOO investment. Okay, that's the easiest way, most hands-free way to track what the entire stock market is doing. And then also go with the minimum down if home prices are rising quickly in your area, because if you're really trying to get into that market, think if it's going to take you years to save for that down payment, well, if home prices are increasing a lot in your area, it's going to be more difficult for you to purchase that home, because in 3 years from now, the home price is going to be higher, meaning that the down payment is going to be higher. And then also the monthly payment is going to be higher as well. All right, so some key takeaways I want you to have here is also that PMI is not permanent. Okay, a lot of people feel really like they hate PMI so much. PMI gives you the opportunity to purchase home with less than 20% down. Of course, it's that extra expense, but with how much homes appreciate over time, it's far less than the appreciation that you will gain on a home. And so appreciation comes off automatically when you reach 22% equity. However, when you reach 20% equity, you can simply call your mortgage servicer and say, hey, I'd like for PMI to be removed. And then also the math often favors a minimum down payment if you invest the difference wisely. Okay. Consider the opportunity cost of what you're doing. What else can you be doing with that money? Do you really need to save 20% down just because you feel like that's what's good, or that's what other people have told you? I think for a lot of people too, there's this moral feeling that I need 20% down to be a ready home buyer, as if there's some like readiness score or other people's opinion really matters all that much. Ultimately, I want you to make decisions that matter for you and your family, right? There's no right answer here. We're simply taking a look at what your situation is, what's happening in the market, what can we do with investing the difference and figuring out what's going to be the best option for you with your down payment. Now, I don't want you to feel like you have to do this alone. And so when you're ready, our team can help you. Again, it's winthehouseyoulove.com, and we can run this math for you to see what the monthly payment would look like with different down payments, so you can get a personalized answer on what's going to be best for you. Get your loan pre-approval, and then you can start shopping for homes when you're ready. Now, if you want to get a conventional loan, you need to know all of the requirements to get it. So right here in my video, I show you a full breakdown of conventional loan requirements.